Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders for the How to Make Money Trading Stocks webinar. As I was saying, we are having some absolutely crazy market maneuvers this morning. And last week was a big up week, and this week is looking like it's at least taken back some of those profits that people gained last week. And so I see Mike is online now. Good morning, Mike.
Hi, sorry about the late check-in.
And so, yeah, I thought you were going to be on an airplane heading to California today.
Tomorrow.
Tomorrow, okay. And so, want to remind everybody that the materials that we do present are for training purposes only, and that members should always paper trade any new method prior to risking their own personal capital. In our midweek market sanity check training webinars, we just concluded with session 3 out of 4 on candlestick reversal patterns, and then we'll be finishing up session 4 this coming Wednesday night, and then the following Wednesday we will go into how to use Fibonacci's. We're getting some interesting Fibonacci retracements actually today, and so we'll be covering that, and then we'll continue to, I always continue to refine, and I know Mike does the same thing. We refine without, significantly changing the underlying system, but we're always looking for something that's going to be able to utilize for an edge. Isn't that right, Mike?
We try.
We try. And so what's going on in the market this week? We're getting a whole bunch of convergence of clues with respect to the market is looking weaker than last week's move may in fact be turning out to be a big relief rally, but it's looking not much more than that right now. The S&P is basically rolled over and it's dropping to, and a big question mark, how far is it going to drop? NASDAQ was holding up the best, had some really good reports, with the exception of Apple, kind of disappointed on the iPhone. And for some of you who heard me speaking on Wednesday night, I was chatting about how this fundamental analysis guy sat in a fundamental analysis presentation at the Money Show, and it was basically the 10 questions you should ask before you buy any stock. And he was talking a little bit about things like McDonald's. McDonald's is not necessarily a stock you want to be jumping into right now, primarily because they're going to have an increase in cost both in the beef. Beef is, if you've bought any beef here lately, you know that it is much more expensive than it was just even a few months ago. And what are some of the other things? What's Mike?
Don't tell that to the Federal Reserve, because they insist that there's no inflation out there.
Well, it's true, Mike. There is no inflation out there except on the things that you need to be able to live. And the other thing that is going up is because of the avian flu. Eggs, the price of eggs are going up, and then add on top of that, in certain areas, the $15 an hour mandatory wages for entry-level positions, and the cost of McDonald's has significantly gone back. That impacts their margins, and hence, McDonald's not looking like a really good place to park your money. He was talking about a little bit about Apple. Mike, I think you'd find this interesting because I know you went right out and bought the Apple Watch, right? Yeah, right.
I'll let my chuckle speak for itself.
Okay, but they were talking about, really cool new product and all that stuff. But it was basically the guy was saying it's novelty. I mean, the big money, the area within Apple that is driving their revenues is the iPhone. The iPhone hiccups any whatsoever, and you get what we got the other day. There's a little bit of disappointment in the iPhone, Apple falls. Well, guess what? Since Apple's the biggest, the big dog in the park with regarding the NASDAQ fell a little bit too, and the S&P fell a little bit. So as I said, the NASDAQ 100 is the strongest, but it will it give way? Russell's weakest, but it's searching for support. Where's it going to find support? Don't know at this point. Outside influences, earnings continue in earnest going into next week. Some of you have probably seen the $74 bounce in Amazon today. Really, Amazon's a very interesting company. But then you see Starbucks. Starbucks got whacked today after earnings. It gapped up and then fell back down. Those are not healthy indications when a company surprises to the upside. China is turning out to be, I found it very interesting, Mike, in the Wall Street Journal this morning, one of the talking heads, or one of the fund managers was basically saying that they don't think China is as good an investor as it once was, and it's probably going to dismiss. A hedge fund manager was saying this, and I find that very interesting because you and I were talking about that, almost 2.5 months ago?
We've been talking about China up to 2.5 years ago.
Yeah.
Actually. Yeah.
And so the bottom line, the question that I'm kind of asking myself today is gravity taking over, or is it really just is gravity taking over, or is it a vacuum effect sucking the life out of the economy? We shall see. So here we are. Here's where we were last week on the percentage of stocks above the 20-day moving average on the NYSE. I've got an interesting chart that Mike sent me earlier in the week that I'm going to share with everybody. I'm going to ask Mike to talk to it shortly. And here's where we are today as of 10 o'clock, as of 9 o'clock this morning. What's going on? Well, as we can see, let me get my drawing tool. Yep. The downtrend of the percentage of stocks above their 20-day moving averages continues. And what we see is we came up, and as the NASDAQ was really pushing up and actually breaking out to new highs, the underlying stocks, and I recognize this is the NYSE, but this is a non-weighted index. The percentage of stocks above their 20-day movers in the NYSE, which has some of the stocks on the NASDAQ, was in fact not making new highs. And in fact, as the NASDAQ was making its new high on the NASDAQ 100, and it wasn't a new high, but it was new high on in the current bull market. This was not, and in fact, it has fallen down from here, and we're almost back down into the lower reversal zone where we anticipate, where we basically say, okay, hey, what's going on here? I left in this place back in October of last year, where we got a really huge, nice bounce. And actually, that was the last time that the percentage of stocks above the 20-day moving average really got in gear and got back above 80%. Since then, every move up has not resulted in a new high, except for that little where we get a Pinocchio above the downtrend line at this point earlier in latter part of June, and now we're falling back down. Where will we stop down here? We don't know at this point, but we'll be watching that to see if we get some new alerts going. But nothing surprising there, is it, Mike?
No surprises there, and I feel like every time we show this and talk about it, we feel like we're beating a dead horse by constantly repeating it. But it's the point that we've been making, if not for months, at least for several weeks now, about just the general lack of market breadth on these rallies that we've been seeing.
Yeah.
And how when you look under the hood of the market, it's not as healthy as it might look when you just look at the the weighted indexes that we commonly refer to.
Yeah, exactly. And, and the thing about it is, the takeaway that we can all take away from this, it doesn't mean necessarily that we shy away from taking legitimate long trades, although we should also be looking for short trades to basically cushion our long trades. But it doesn't mean we necessarily shy away from trades, but you reduce your expectations. All of a sudden, where you may have been looking for a 10, 15, 20% gain, all of a sudden you become happy with a 5% or pushing 10%. And it tends to be that we take our profits a little bit quicker, and we also want to take our losses quicker. We want to basically keep some really tight stop losses, keep your stops. As long as I can keep my stop losses within 2 to 3%, it allows us to still, maintain a pretty good reward risk ratio. So here is Mike talking about under the hood.
Well, okay, that's the one I thought you were referring to.
Yeah, Mike sent me this chart earlier and said, he goes, I think you'll find this interesting. And what there is this QQEW is basically, it is an ETF, but is an ETF of the NASDAQ 100, but it's equally weighted. And this little chart down here, the blue line down below here that as you can see is pointed downward, this is the ratio between the two. And as you can see, the cubes have been, they're on a tear. I mean, basically back here in 2009, they popped up, but at this point in 2011, the weighted and the non-weighted entities within the NASDAQ 100 diverged. So, Mike, what is this chart telling us?
Well, it's the same thing we just talked about. When you take the weighting away from the handful of really big cap stocks in the NASDAQ and you make them equally weighted with, the much smaller ones that nobody ever talks about, again, as you title the slide, looking under the hood, we're seeing that, the breadth and the move of the weighted index just doesn't reflect what's going on with most of the stocks in the universe that are available in the U.S. to trade. And as this ratio between the the weighted index and the equal weight or the non-weighted index declines and they diverge away from each other, sooner or later that divergence, as most divergences, needs to get reconciled. Historically, the reconciliation has been in a downward move in the weighted index, which is what we're seeing, at least for today. And that's basically what the chart's telling us, and trying to compare what's been going on, very recently to past occurrences.
Yeah, exactly. And I like, and for those who are interested, you can pull up this here. This is the ticker symbol.
Ticker symbol.
Yeah.
It's not an entity that anybody would want to trade. I mean, no. It doesn't move very much. There's no volume to it, but it does give you, at least for the NASDAQ, a look at what's going on when you take the weighting away from the Facebooks and the Googles and the Apples. Much like trying to look at the S&P 500 compared to the NYSE Composite, and there's a ticker symbol for the NYSE Composite also.
Yep, that's NYA, I believe.
NYA on the Thinkorswim platform.
Yep. And so what's very interesting, though, Mike, is after you sent me this chart, I did, in fact, do a comparison between these two. I took the Qs and I took the QQEW, and you can do a comparison chart on that. Very, very interesting. The correlation between the two, when I compare the QQEW to the Qs, of course, it is a down-sloping comparison. And of course, on the flip, which is what you expect. But it's just kind of an interesting little secondary. I'm not going to make any trading judgments off of this particular, slide, other than its hip pocket information that's letting us know a little bit more about what's going on under the hood, of these indices, in this case, the NASDAQ 100, that belay the actual, it provides some additional truth into what's really going on, rather than what the naked, or what the index itself is telling us.
Yeah, well, the real tell on that, this past week there was a lot of, in the mainstream media and financial headlines, a lot of hoopla around the NASDAQ and the NASDAQ Composite and the NASDAQ 100 making new highs,
right,
on these big moves that, Google and Netflix had. But if you pull up a chart of the QQEW, and you were not putting in a new high. And that's the tell.
So cool. Anyway, just a little bit of information. I just love these things. Either Mike, typically Mike comes up with these additional, because he does a lot of research. Occasionally, I can pop one up here from the research that I do. But these little extras that we provide in this weekly, Friday, webinar that provides a market update, and I hope that it gives you food for thought as you plan your trading going into the following week. So as of 9 o'clock this morning, here's where we stand. As we can see, the Dow is back down in negative territory. The S&P has dropped from where it was last week, because the comparison is here's last week, 717. The NASDAQ has dropped from last week, not as significantly as the S&P and or the Russell, but it has dropped a little bit. It doesn't take much for the NASDAQ to catch up. So this oftentimes, as you saw earlier this week, I think there was one day where the Russell was actually up and the other two indices, our tracking indices, were down. And so that mixing of markets where one is up, the other ones are down, or vice versa. Yeah, David, that is Pacific time. But when these are basically, when the markets are mixed, it is not necessarily a sign of health. And what's happening a lot of times is the markets are as they're mixed, are looking for how can we get in sync with each other, because normally they like to be in sync with each other. And so right now, that's what we're waiting for. But no surprises there. Let's go to the charts real quick. S&P. That's the monthly and there we go. Here's what I'm looking for. Okay. Yesterday, the S&P dropped directly to the 50-day moving average, and now it's stepping down again to the 100-day moving average, and of course down here is the 200-day moving average. I laid in this Fibonacci retracement just to give you an idea of, isn't it interesting how it dropped right to the 38.2, and now it has actually penetrated the 50% retracement on the Fibonacci, right below the 100-day moving average. And so this trend line, which was restored when prices went back up above it, is again in play. If we break through here, then we're probably, the 61.8 is in play, the 78. And if the Fibonacci is like the 61.8 is broken, it really increases the probability that we will get a full retracement down to the previous lows or previous swing lows. That's kind of interesting, because we've got kind of a reverse triangle going here on a daily chart, where I can actually just draw let me do it with the other. So I can basically draw, okay, here's our highs, and then we've got these series of lows, and it's an inverted triangle that tends to be not a very it's not very structurally sound, and what's the word I'm looking for, Mike? You don't know.
I don't know.
Okay, it was an engineering term, but anyway, not very structurally sound, and has the potential of being quite, catastrophic, but we just will watch what happens in here. Breaking through, if we close below the 100-day moving average, it dramatically increases the odds that we're going to at least fall to the 200-day, and as you can see, that is very much within reason. On a daily chart, while this was not a huge uptrend because of the size of the candles on the weekly chart, it's a 1 week uptrend, and today we would be getting a dark cloud on for a candlestick if we in fact close where we are. And as you can see, the momentum is still coming out of the true strength indicator. True strength index is still pointing down, and the momentum is still downward on the actual momentum indicator, the NASDAQ. The NASDAQ, as I said, was holding up fairly well. It was until we break down below the 8, because you see how we came in on yesterday, bounced off the 8, but still closed in the lower half of the candle for yesterday, and now we get finally a breakthrough. The one thing the NASDAQ has going for it that the other indexes do not is it did make a really nice breakout of this level at the 45.50 level. This would be an area where we could potentially look for some sort of a reversal. Now, it may be only a reaction reversal, such as a relief rally of such to bring it back up, and then we'll be watching if we get that that move where it goes down, hits the support, comes up, fails to make a new high, and then rolls over from there. With the craziness that's going on in the economy and how they have modified the way how the government has modified the way they look at things, it's almost like the economic reports are kind of like almost like red herrings. They really are meaningless. It's going to the third-party data providers that actually provide probably a better picture. And while the government is reporting low inflation to zero inflation, right, Mike?
Just slightly above zero.
Slightly above zero.
Really.
And each one of us knows that, and this isn't, I'm not hitting on the government, but each one of us knows that, I don't know about you, but my cost of living has gone up. For food, for gas, for utilities, like I said, the things I need to live, my cost have actually gone up. Healthcare, and so it's like, how do we trust what the government tells us? Because they're making decisions that could impact the economy even more going forward. And then you throw in the things like, what's the employment rate? The jobless claims today went down. And so one would think, oh, well, that's good for the economy. But according to the guy I sat in on his lecture last Saturday, is that take a look at, and I think it's either Forbes or Barron's that puts out this third-party information, the labor participation rate in the United States as of right now, or as of when he did the last week, was sitting at about somewhere around 48 to 47%, which basically means that but our unemployment's sitting about what, 5.8, 5.6 right now?
Officially, unemployment's around 5.2, 5.3.
Okay, even lower than I thought. Whoa.
Yeah, but you know, the point you're trying to make, and I've seen different numbers, but the point you're trying to make is absolutely true. I think that the official numbers are adjusted and then adjusted again and then double adjusted and then seasonally adjusted. And you know, the administration, the government, you know, the Federal Reserve, the Bureau of Labor Statistics have a vested interest in trying to make things look as good as possible. And you have to dig a little bit to find out what's really going on. And when you do that digging, the labor participation rate that you're mentioning, I've seen different numbers. I've seen it down around 62%, which means that 38% of the people who are in the age bracket and physically able to work in the United States are not working.
Yeah.
And this is the lowest number we've seen since, you know, Jimmy Carter was president in the late 1970s. Over 100 million Americans of working age and working capability are unemployed.
Yeah.
But they aren't counted as officially unemployed if they've given up and they're not looking for a job.
Oh, exactly. So that's what, yeah. And the point being is that per the data the gentleman had last week is that it was the first time in history where, or first time in this particular report where the labor participation rate had dropped, you know, below 50, where, you know, 48, you know, there's more people unemployed than are actually employed. And so that's kind of freaky, and that can be kind of scary. But back here, just taking a look at the NASDAQ real quick, is we got the we have the true strength turning over. Momentum is still hanging up, but if we get some more downside here, this will also begin to turn over. We got a little bit of a pop up and then a roll over from here. Don't be surprised with the volatility that is in fact coming into the market as we speak. We'll switch really quick over to, and then go on to the Russell. As you can see, we came down on the VIX down to its previous lows, and we get a rebound. And this has been fairly predictable over the last, you know, several months. Is when it gets down in this area, typically that marks the market high, and then we get a rebound. Now, will we get all the way back up into this area where it's, you know, up around the 20 level? We shall see. But right now, the linear regression on it shows the midsection at about 12.5 or 12.8. It's when we start pushing back up about 12, above 15. If you're an option trader, it's up in this area where you want to be a seller of option premium, not a buyer. Down here, it's a great place to be a buyer. Russell. Russell. There we go. So I think I left the, yeah, as you can see with the Russell, it has continued to fall lower. It is looking for a place to turn around. Will it turn around here and do a rebound? We shall see. It is back at this level of support from the uptrend line, and we'll see if, you know, if it retakes the 78.6, then that typically means that we're going to at least go back up and test the 61 or maybe even the 50. So we'll see what is in store for that. The Russell may be, you know, going to be able to come back all the way down here to the 1215 level, and we'll be watching that. And as you can see, it is the weakest of the indices. Put in a nice evening star up here, and then has rolled over from there. And I think part of the thing that's pushing the Russell down today, Mike, is that the Fed is not backing off of their intent to raise interest rates before the end of the year. And it's almost like, you know, they have their credibility is on the line. If they don't raise rates, regardless, their credibility will be even lower than it already is.
Well, that's making the assumption that they have any left.
Okay. Well, I mean, even even if it's in negative numbers, that's still, that's still some.
Yeah, that's a different conversation. Hey, a couple of little kind of interesting little nuances I think I can point out on the charts. If we can go back to the SPX weekly chart.
We can. And so, and for some of you who follow the strategy 3 trades, yes, we are in a short put position on one leg of this. That's one of the reasons why I did not open a full position, is because of the potential weakness in here. And my objective is to just hold on, see if we get the reversal, and then utilize the 2 remaining contracts that I can be selling to basically cover the 7 long puts that I have. That's what I'm basically waiting for to probably go into next week to be able to repair what's been done on this already. But at the same time, I wanted to have that flexibility, and I didn't want to be fully invested in the short put. So there you go, Mike. S&P.
Oh, well, weekly chart. I mean, I'm assuming that the weekly chart isn't going to change too much between now and when the market closes today. On the right-hand edge here, the past 2 weeks, we have this, what we call a left-right combination. An extremely bullish candle one week, an extremely bearish candle the next
Correct.
week. And it is also almost what can be referred to as a 2-week or a 2-candle tweezer type formation.
Correct.
Or a railroad track type formation. It's almost but not exactly those things.
Yeah.
But the implications are the same. And typically, generally, whether no matter the time frame, you get that kind of combination set up. Typically, pretty bearish.
Yeah.
We don't know what's coming next, but we can assume, just based on the setup, that there will be more downside to come. And certainly, if you go back to the beginning of April, you'll see almost the exact opposite after a minor period of selling, beginning of April on the weekly chart, Dennis.
Right here.
Oh, I'm sorry, April 2014. Wrong year.
Right here.
Yeah.
Okay.
You see sort of, a very bearish down week, and then following a very bullish up week, a left-right combination, sort of a railroad track tweezer type formation, and how that followed through afterwards.
Yeah, without a doubt.
Yeah, just a little nuance or a little tidbit, I think, on candlestick analysis and interpretation.
So I agree. And here I'm going to put a.
And we also talked about, and we talked about it as it was happening when we hit this bottom here a couple of weeks ago, and we had this sort of V-shaped rally in the S&P on virtually, almost
right
a V-shaped rally on virtually no volume, and I know you mentioned on a webinar how these kinds of rallies are very suspect and usually pretty short, and then they fall apart, and that's exactly what we're seeing happening, and we've seen it happen before. I mean, we have a series over the past few months of these V-shaped rallies that, at some point after, a couple of weeks or so, they just pull back down and give back much of the gains that were made.
Yeah, exactly. And so right now, with these huge daily candles, it basically we kind of wait. We wait until we get some small bodies and or some extremes in the individual indices before we move on anything else. So I think we covered the Russell, didn't we? We did. So we're hanging on to that. let me go back to here. Okay, as of, I just want to remind everybody that, here's what we do at the active trend trading. IBD quality stocks, what to trade, and index ETFs, both leverage and non-leverage, when to enter, when to exit, what strategy to use, and what to expect. Here's where we set, or here's where we set a little bit. We made some improvement over last week, and we're trying to continue to push this up. But with the volatility and flexibility in the market, again, it gets back to small profits, smaller than expected, but also keep your losses extremely small. Active trend trading in the three strategies we support: stocks, index ETFs, basic options, and then some wealth building and income generating. How we've been doing. Here's where we're sitting with, well, this is a spider trade that I do on my own account, and where it's sitting, and really pleased. Didn't have an open position on the spiders this week because this is a put trade, because I'm anticipating the market falling sometime between now and January 2017. Strategy one, we were short beta on the real rapid, we closed out our second 100 shares for a profit of 2.38. We had a profit of about 5+% on the 200 short shares that we were short. FireEye got we had 300 shares. We got a nice bounce, sold 2/3 of the position out at 618, and bam, it gets stopped out at break even today. I want to thank Lyle Wright for asking the question about that I covered last night in the market update about bringing up your stop, your profit protection stops. We did that. LCI, we got stopped out of that for about $384 loss at 2.16% loss. That's what I'm taking. If I can keep when I do have a loss, if I can keep it between 2.16 and 3% in this kind of market, I'm very pleased with that. In EPAM, we are holding for hopefully a earnings run. We're in at about 74.95, and it's just holding right there. At least it was as when I wrote this. I'll have to check the charts after we're done. Simple option strategy, we made no trades this past week. Wealth income generation, we gained 405 for the week. We have a potential for 245 that is in place already. But as I said, with the market falling, the index for IWM falling, some repair work will probably have to be done on the current open position, and that's why I have excess contracts to be able to trade into that. Early warning alerts, we are waiting for a new setup. So for those who will be watching the recording, if you are watching the recording, of course, we do offer the active trend trading for a 40% discount for folks watching this show. And then on the early warning alerts, also, that's a yearly subscription, as offered at a discount because you took time to watch the show. So until next week, I just want to say, guys, have a great weekend. Continue to grow the egg, protect your profits, and also keep your losses fast and small. Mike, I know you're going to be out here this weekend. For those back in the Southwest, I will probably be in Arkansas the first week in August. My mom, who's 85, well, she's not doing too well, and so I'm going to have to go back and take care of some family stuff, but I will be back in Arkansas, and they do have internet connection there, so I will be broadcasting from there as I'm taking care of Mom. So, Mike, you got anything?
Sorry to hear about your mom, but August is a lousy time to be in Arkansas.
Lousy
time to be in Texas also.
There are so many things I could say about that, but I'm not gonna.
We'll talk later.
Okay. And hey, Tracy, I will be up in around the town of Paragould, Arkansas, which is about 30 miles from Jonesboro, where the Arkansas State University is. It's up in the northeast corner. We fly into Memphis and then typically drive up from there. And so now I'm very proud of my roots that go back to Arkansas. So, okay, let's take a look at some charts if you are ready. Anybody have any charts we want to look at? Let's see how FireEye is doing. As we can say, FireEye still is holding its support here at 46, but as you can see, this was got this really nice upside move with increased volume. It looked like we were going to, jump into gear, and away we go, and then we get the reversal today. And I basically just put since we'd already taken 2/3 of the shares off the table, I just made the rest of it break even, and sure enough, we popped out at break even. Let's see, we have AK stands for Arkansas, not a stock symbol. EPAM, EPA, no. You would think that the EPA would be a stock symbol, wouldn't you? But it's not. So EPAM is, here's the deal on EPAM, is basically, we got into this trade with at I think just at 74.90, I think, is somewhere around there. And so as you can see, it's fallen off a little bit, but this trend line is still in effect. The 50-day moving average is still in effect, going up. And what I was intending and wanting was basically based on earnings that are coming up the first part of August. Oftentimes stocks will go on a 5 to 10 to 15% run prior to earnings. At this point, the volume is down. It's not selling off hard, but at the same time, we're keeping an eye on it. And this is where the decision process is so challenging occasionally. Is I could put a stop loss right below this low, but what does that do? It puts me right at that particular uptrending support line. And so this is where we play, go ahead and take the stop loss there, and if it goes down below and then pops back above, you have to be ready to get back into the trade. So that's what's going on with that. ANAK, ANAC, excuse me, Judy. Okay. Somebody knows something going into earnings. Hence the huge, and if this is a perhaps one of their drugs that was in clinical trial was approved, or something took place to get this nice, significant, huge gap up. Because I mean, look at this. This is almost 100% gain in just a few days. I mean, we jump from here to here. That's 83%. So that tells me either they are, something's going on, either, positive information on a drug test, and or somebody knows something prior to earnings, which are coming up on August 6th. At this point, Judy, if you're long the stock, great. If you're not, you're going to have to wait for something constructive to happen where it's going to pull back into a proper buy point. And let's see, Cyber, I believe, is also looking at earnings in a little bit, August 11th. Cyber made a really nice move basically off this $55 support range, popped up, and now got above the 50-day moving average, and then is dropping down below it. But given that the markets are selling off the way it is, this is actually strong behavior for a stock. So what might we get? We may get a earnings run. So look for any type of a pullback to a support level, or for the moving averages to catch up, but down to support and then a ricochet off support. Like I said, nice gap up out of the consolidation area here to break above the 60 level. When you take this range from 55 to 60, it gives us an upside target of at least 65. CLGX. Okay. Earnings yesterday beat earnings, and it's basically looked like it is testing approximately that breakout area. And so the question is does it rebound off of here to go higher? Right now, that is it's a bearish candle, but not a reversal candle. But then it looks like it is looking for support. Does it find it at the breakout area or not? And what's your potential upside from there? You've got here from 37, and I'm rounding the numbers. So from 37 to 40 is $3. So that would be from, if you break out above 47, $40.75, give it another, $2.50 to $3, which would put you up at your measured target for the potential trade. So any other stocks to look at, folks? Let's see how IWM is holding up or not. And right now it is basically doing a nice little sell-off. We'll see if we rebound here, and which this is the idea place where it would potentially rebound. So let's see what happens to it before the end of the day, and then we will plan what we're going to be doing on this on the positions that we're open on going into next week. QLIS. Tracy, you like that one, don't you? Oops. Okay. That's interesting. Drop off. What are we doing here? I mean, it looks like, okay, we fell out of bed here because of earnings. Where earnings are approaching again. This seems like it's a short period of time between here and here, though. Yeah, well, it's 90 days, okay. And so we found support at 36, and it is flirting, but it's got basically earnings coming up the first week in August. At this particular point, I would kind of just wait on this one to see if it does, if it gets this consolidation going between 36 and 40, and probably wait until after earnings are over. Okay. You do one more, folks. Okay, I'll be writing the traders report and getting it out prior to probably tonight and first thing tomorrow morning. I'm going to be going to a Market Smith's seminar in the morning in San Francisco, and then my wife has a family reunion down by Morro Bay later in the day. I was waiting for that. Let's talk about this one for a couple of seconds. Paycom had been a big performer early in the year, but as you can see, it was very volatile and jumping around. Didn't have a real great pattern, on the daily charts. The weekly charts were a little bit more tame. And so what's going on here? Yeah, we come down, we hit the 100-day moving average. It starts building back up. It's got earnings coming up on 8/4. But this is one of those where you look and you go, this wedge up is very suspect, because look at what the volume's doing. It is basically below average, and then the one day you get a peak in volume is the day it puts in a shooting star and then confirms to the downside today with this significant move down. What it dropped from 36 down to 34. And so again, with earnings coming up, a big huge drop like this makes it very questionable, does somebody know something? I always kind of, am suspect. Does somebody know something about what's going on with this stock internally that the rest of the investors don't, and they're adjusting their position accordingly? What do we have going on up here? Basically, we could be having a little bit of a head and shoulders type pattern going on. Shoulder, small head. And if it breaks and it goes up here a little bit and then falls, or just basically a kind of like a rounded top, we could come down and see, Dennis. Okay, there we go. What we could be seeing is, I'll take a look at this. If this was a shoulder and this is a head, if it gets back down to here, then it could pop up above and then fall from there. But that could take place over several weeks. So, Tom, I haven't seen that one in a long time. YNDX. This is one of those, I'd have to do the market stock checkup on it, but it's got pretty good volume. This used to be it was a big winner back several years ago, where it went on that tear back in 2000, I think it was 2013, and it was a darling. What's interesting, and why you may want to keep your eye on this one, is it is in the process of consolidating. And this move from here to here is a 47% move. And so, if you get a stock that has been a former leader and with this kind of potential, I'm not against keeping your eye on it, because oftentimes it will be a really great turnaround later on. And as I said, from here to here is about 40%. And if it consolidates and breaks out from there, it could be even better. And so, as you say, Tom, waiting for a bounce off 14, pretty good fundamentals. Yeah. And this happens quite often, where you get these basically, falls out of favor, drops like a rock, finally starts putting in some consolidation. And when you start getting the constructive action and the rebounds back up, I'd be looking for, on a daily chart, I'd be looking for some reversal candles down in here, and recognizing that if it breaks below that previous low of 14, or it's actually 1390, you're going to be gone. You're going to be out of the trade. So, guys, I want to say thank you very much for joining us today. I'm going to wrap it up. Yeah, positive divergence on the weekly, Tracy, you're absolutely right here. I'm going to wrap it up. Have a wonderful weekend, and again, if this is a good market to stand back and watch, you don't have to be invested all the time, and if you are, keep your position sizes manageable. Have a great weekend. God bless everybody.